Hi everyone. Right now is the new June transaction review and calculator practice. I don't know how many people can see. If you've been here before, you know to use the little chat button. And just to let me know that you're here if you want to ask questions. Hopefully you can, let me see if I can unmute people. I know some people have appointments tonight and things like that. Thank you very much for being here. If I can get away with it, I'm going to keep everybody unmuted. So who? Oh, great. Somebody's speaking. Hey, Mike. Great to see you. Very great to see
Hi,
you.
Don.
Hey. Yeah, how's it been?
Busy.
Yeah, good. With what kind of work?
Difficult transactions.
Are you still working the multi units?
Yeah,
All right,
yeah.
fabulous.
I got involved in some ghetto stuff, so that's really what's tying up my time.
Oh, the slumlord stuff, huh?
Yes.
Yeah. Okay, great. Well, thanks for being here again, and everyone who is here and will come. So we kind of have I put in more than the usual amount of transactions, so we're going to just start blowing through it and just start this because I want to get through and then still have time for questions. Before we start that, any burning questions, any deals going on for someone that they need an exact answer on right this minute, etc., etc.? Anyone have something, you know, uh, gosh, that they can't wait, they got to get answered tonight? Okay, good. Well, if you think of something, let me know, okay? So, what I'm going to do for today is let's see, two of my clients that I'm doing right now that in the terms of buying a property, and then there's a couple note deals sort of worked in here too. Okay, so this client came to me. They said, we've got, $50,000 down payment, but we can't qualify for a loan because we don't have the seasoning and sourcing in our jobs. We're kind of self-employed, sort of. But we can afford, they said this, we want the price range under 250,000. This is somewhere in the San Fernando Valley. For those of you in California, that would mean something. Um, they want to keep their PITA, their total housing number, and this is pretty low, right? So we're going to have to be creative here. I think Ed just came in. Okay. And so the first thing I have to do is, reverse engineer this thing, right? Okay, I know that if we buy a house at 250,000 in California, there's going to be 1.25 property taxes per year. So if you do 250,000 by 0 point, no, 0 point, oh gosh, what is it? You have to do two places. Doot. Okay, so I'd have to go 250,000 times point oh, oops, 0.0125. Okay, so that gives me, that's for the year divided by 12. Okay, I have to figure that they need to put 260 a month aside for property taxes, insurance about $80 a month. So I already know that my monthly taxes and insurance, T&I for them is going to be 340. So then I have to go, okay, if they want to keep their PITI or their total housing expenditure at 1300, I have to subtract out 340, which leaves them 960 for P&I, principal and interest. So that's going to be a challenge, but let's see if we can do it. When I went to the MLS, obviously, does anyone know what's going on right now? With properties less than 500,000 in Southern California. Anyone submitting offers on those right now? Well, what I'm finding is that there's multiple offers the first few days that these properties are on the market. So what I ended up having to do was say, look, we're not going to be very competitive with people who, either have all cash or 50% down and financing, something like that. So when I customized the MLS for them. I specifically said no short sales, no REOs, which automatically cuts out like 80-90% of the market, right? And then furthermore, I'm mainly looking at properties that have been on the market longer than 90 days and or expireds. And what I did, because it's just so not worth, and I was going to share this with you guys in case some of you are, I know some of you are real estate professionals. And so here's what I did. Instead of writing up a big long bunch of purchase contracts that then they got to sign it, then I got to get it back, and blah blah blah, I just created this one-page document that I'll put this up on the website in case anyone finds any meaning in downloading it and customizing to themselves. So what I did is just say the date, obviously my logo, my contact information down here, my license number, blah blah blah. I said, Dear Adrian, I have clients that would be interested in this property and will pay more than full asking price in exchange for terms for up to 5 years, although they plan to refinance in 1 to 2 years. So even though my clients are very confident that they'll be able to get a traditional loan within 1 to 2 years, I don't want them locked into that. Because if they're putting down $50,000, that's a lot to potentially lose with a short-term balloon. Plus, with Dodd-Frank, SAFE Act, and all of that, with owner-occupants, that would be like a potential lawsuit waiting to happen. Plus, it just doesn't serve everyone, right? So I would prefer that they'd actually carry out 7 years, but to not like scare everyone off right at the beginning, I said 5 years, which is, 2 or 3 times as long as my clients think they'll need. And I say to put towards a lease option or traditional seller carryback, they have up to $50,000 to offer at closing. So this is listed at $224, and it's been on the market for over 90 days. I think it went on the market, back up offer, pending, back on the market, pending. Anyway, it's an out-of-state owner. They have no mortgage against it, and but they don't seem to really be in a hurry. So down payment, so then I bold this out. Here's $50,000 at closing. You'd carry a first note and deed for $189,000, and then I show the payments. Obviously, that should be a dot, but anyway, I worked out. Remember, $960 they can afford. So this one, I'm just plugging in like 4% interest, amortized over 30 years. So the payment is $902.31, and then I'm saying if you carry the whole 5 years, you'll get $54,000 and change over 5 years. And so here's the total to the seller for what they have listed right now is like $224. The seller would get $275.85. And then I put alternatively, if the seller would like to generate more cash at closing, I can arrange for the partial purchase of the note, bringing $37 more to the closing table. Okay, so here's what I'm doing. Here's what we got is $189. My PV there. I plugged in 4% interest rate. Okay, amortized over 360, and then I solve for payment. That's where we got the 902.31. Also, I want to know, how did I get the balloon? So now we press here, as you remember, to get the amortization. And I go down to 60, and here's the balloon, 170,946. Okay, that shows me what the balloon would be in 5 years, 170,946. Okay, so that's what I put there. I added down payment, the monthly payments, plus the balloon to get that number. Now, if I'm thinking I'm willing to come in and buy a simultaneous partial note, I'm willing to come in and buy 60 payments at 902.31, but I don't want a 4% yield. Actually, I'm probably looking at a 16% yield at least on this. Okay, so now let me press present value. Okay, that's $37,000 that I would be willing to pay for the note. Okay, so then at closing, that jumps from 50 up to 87,000, and then they still have the same balloon, and 5 years are left. They'll still get more than asking, right? $257,946, and I just say, gosh, don't hesitate to call me. you know, I'll drop all the paperwork if it gets relevant. So, oops. Okay, get that out of the way. Now, the other thing that I did is, well, we could go for a lease option, which I mentioned in there, and in that case, they would have to come out less out of pocket. We wouldn't put $50,000 for a lease option, most likely, maybe 5 to 10%. But then, you know, we can keep their payment, their lease payment at $1,300, and maybe we can even negotiate for half of that to come back to them as an equity for purchasing the property down the road. So that might be a way of them getting even better than the financing that I'm proposing. So we're open to all of it. So far, everyone's come back saying, no, we just want a regular sale. But thank you very much. You know, good, basically good luck. All right, so we'll just have to wait to see if there's somebody that's motivated enough and they're willing to just hang out for terms. In the meantime, I also look on Craigslist, and the way this might be really boring to some people or really super obvious, but just, you know, letting you know what I'm doing on behalf of my client in this case, I would just say U.S. Where is it? San Francisco, Santa Barbara. My gosh. LA. Okay, real estate for sale. And now up here, I don't want by broker. So much stuff. All brokers and agents are using the Craigslist, and I don't want that. So I'm going to push by owner. So now, theoretically, I've carved out the brokers and the agents because I already know they're on the MLS, or they might have a pocket listing where they're trying to double end, and that's fine. But so some of these will be agents in disguise as owners, and some won't. In fact, I ended up calling several of these, you know, and one agent was looking to double end it, and I didn't mind giving him the commission if he would have carried, and then I would have received a commission on the sale of the note, or I would have bought the property myself, getting in the middle, making a monthly spread instead of some money up front, that kind of a thing. So, but he didn't want to carry it all. I had one other guy who said, yeah, we'd be willing to carry, and we'd take $50,000 down. That's great, but we're going to want 8% on our money. And I go, wow, that's going to put him $1,000 upside down every month. And so, you know, pretty close, but no cigar. But just letting you know that, you know, you can find some stuff here, and that's how I did it. Okay, so it's kind of interesting to add that to what you're doing. You know, in the MLS. So in my home, I just set up these searches for my client. Okay, and so you can see based on what I've set as her things, I'm looking at actives, expireds, the type of property, the areas she wants, 0 to 30, price range, and then down here I say I want everything except real estate owned, short pay, probate listing, auction, HUD owned. Okay, I want everything but those. So usually people are pretty good about putting that in. Sometimes they don't. It's really a short sale, and they're making it look like a standard, etc., etc. Okay, so just a little bit of insight on that. Any questions? Please feel free to use the chat button. Okay, so the jury's out. The latest thing I've told her is to start looking for rental listings of places she wouldn't mind owning, and we'll start calling the landlords and seeing if they're open. Just to let you know, for me, before I really like these people. They're nice. Plus, I asked them to sign a buyer-broker agreement so that if and when they buy anything, whether it's on the MLS or not, I'm getting a minimum 3% commission from them. Okay, so that way I can afford to go outside the MLS because I'm covered on that side. Okay, anyway, so they're going to be calling on rentals too, and if they get any landlords that are open to the conversation, that's when I'll come in and help negotiate and put the deal together. All right, next one. This is about an RV park, and this is actually from one of our members, and I don't think he's on. He was going to try to be on tonight, but we've emailed back and forth. He's a real estate agent for RV parks, for not mobile home parks, but just these recreational places. And this is one deal that we're trying to see if we can put it together. We're really close. So he's got a guy with an RV park up in Oregon on the coast. He's asking $399, and there's somebody in San Francisco selling their house that'd be willing to put $200,000 down, but and move up there and be an on-site manager, but they need $1,000 per month income. So that's what the buyer is at. And anyway, going back, we have a first lien of $80,000. We have a second lien of $40,000. So the total encumbrance against this RV park is $120,000. But that's okay, because the $200,000 down payment will take care of the first and the second. Of course, that'll eat into what he walks away with. So if he carried this $199,000, he would only get like what is that, 60, 70, 80, if you count this, $80,000. This is without closing costs, right? He'd get $80,000 at closing, and then he'd have a note. If we amortize this $199,000 at 4%, so let's do that right now, because I want you guys to get really just brain-numbingly familiar with the financial calculator. And again, for anyone who's new, this is an HP 10B2, and you can get it from In a Day Development. So let's clear all. Oops. Okay. So $199,000. We've already figured that. Okay, just backing up. We already figured that $2,000 or less a month in a payment or so would give $1,000 positive cash flow on this particular investment. So we get $199,000, and already played around with the numbers. So it works out to, well, about 4%. And as this is a commercial deal, what's really great is they have a pretty good amortization. A killer that I see sometimes on commercial or mobile homes is when they amortize, over 10 years. It's almost a deal killer. At least try to keep amortizations less than 15 years. Mobile homes, a lot of times they're at 4, 5, 6 years, something like that. Okay, so that's good. So the monthly payment comes out to $2,014. So we entered that, then just solved for payment. Okay, so now we're up to speed. So the only thing is, he's going to get his price, and he's going to pay off the underlying, and then he'll own this first TD, right? Trust deed. But, okay, the seller's needs. He got stuck in this RV park. He was rapidly building up his portfolio when the market kind of turned on him. What his needs are is he wants to invest in another property and kind of get himself jump-started again, and he wants as much cash as possible at closing. So we already said from the down payment, $200,000, then we got $120,000 in existing liens, then there's probably going to be at least $20,000 in closing costs. So he might walk away with $80,000, right, at closing. I mean, sorry, $60,000 at closing. So that's not very much. So then he's going, can I sell the note? If he was going to sell the note, let's look at what that might be. Okay, and I don't know about you guys, but on a commercial deal, even with a huge down payment, that's 50% down, and a short term, the interest rate on the loan's really small. I would peg that this note would sell to somebody at between a 16 and a 20% yield. So let's plug those in. Okay, we have the loan amount, the amortization, the monthly payment. Let's plug in the desired yield. So there's 16. Let me plug it in there. Now let me solve for PV, which is how much I'll pay for the whole note. Okay, so if I, at the most, okay, with only needing a 16% yield, but that's over 10 years. I mean, personally, I probably wouldn't do that, but maybe somebody might be happy with that. Probably not me, but somebody could theoretically be happy with that. They might pay $120. We can see if we get closer to 20% yield, which I would want at least that, especially hanging out for 10 years on this. and it being a commercial building, like what am I going to do? Go up and start running the RV park? I mean, there's a lot of implied extra, work there. So now I press this and basically 104 something. So I would say that the full sale of the note would be 105 to 120. So basically, if we say that, even if he gets the 120, he's gonna get his loans paid off, and he's only gonna get 180,000 cash. Okay, I mean he's going to get 180,000 cash, which theoretically isn't that bad. But look at the cents on the dollar, 120. He's probably gonna look at this as a pretty hefty discount divided by 199. Okay, that's 60 cents on the dollar right there. Okay, even though that might be pretty good, considering the market, he might say, oh my gosh, no way. You're whacking off 40% of my paper asset right at the start. Okay, any questions? Remember, you can type them in or raise a hand or something, and we'll stop, okay, and we'll unmute everybody. So then, knowing that that was probably going to be sort of offensive, what I said is it's a much better deal if we just do a partial. Okay, so let's go back to the original note, which is this 199. Okay, making sure to enter everything again. So I want to know if I buy the first 5 years of this note, a 60-month partial. First, I got to figure out what's the balance going to be. So I'm going to press this orange button and the little amortization button up here. And I'm going to go down and see in 60 months, I guess, look, I could use this little feature right here. Press in 60. Then I know at the bottom, okay, this is probably hard for you to see, but that's 109,400, okay? So now I know that, let's see if I can move this over a little bit. Oops. Okay. I don't want that. Okay, now I know that the balance in 5 years, if I only buy the first 60 payments, when I give the note back to the note seller, he's still going to have a balance of 109,400. So that is a number that we use to sort of package the note deal to him. So if I was going to, knowing that he's going to have this at the end and I'm only buying 5 years worth, I think that a partial could give him 76 to 82,000 versus the whole note at 105 to 120. Okay, so you can see that the discount doesn't look quite as offensive. So even though we're going to plug in the same yields, right? So instead of this number being, we already know that this is the monthly payment. That doesn't have to change. But we know we're going from 120 months down to 60 months. So let's plug that in, and then let's plug in our yields on the high end. I would still want 20%, even hanging out for 5 years on this deal. I might take less, but just let's putting this in, right? So then we get, so we plugged in 20. Now let's solve for present value, which is the amount we'd pay for the note. So $76,000, okay? Or maybe you round up, make it look a little better, $50. If we plug in 16% for the partial, solve for PV, we might pay $82,850 for the note. So somewhere in this range you could buy the partial. So, and he gets to keep the balance, right? It looks better that way. So at closing he'd get his $60,000 after paying off the underlying. Then he might get $76,000 from selling a 5-year partial. So at closing he could get like $136,000 instead of $60,000. So I'm guessing that 136 will go a lot farther in getting him his next investment than 60,000, and it's less than 180, but still what this does is leave him an extra 109,000 of his asset, right? So it's probably a much more palatable situation. So with that balance left coming back to him in 5 years, he's going to get 245, 400, or if you count in the loans that he paid off, for his 399 property, he's going to get really dang close. He's going to get 385, 400, okay, in the exchange for getting more cash at closing and getting his price. So we're going to see if he goes for this and if we can make this happen. So any questions so far? Okay. Let us move on to the next one. Oh, time is going so fast. This one, lease option or wrap, I think I'm going to skip in the interest of time and wanting to leave for other deals. I might do this one next time because this is a consulting client of mine. They're in Florida. I can't remember which city, but in a nice area. They have $250,000 to put down, but they can't get a loan because they're right now going through a short sale on their existing home. So their credit is horrible. You know, it's like in the low 500s or high 4s or something like that. So, but we're looking at a property where the purchase price is $650. There's an existing $400,000 loan. But anyway, I'll save this for next time because maybe we'll see what happened on that one. Okay, but anyway, just showing you that you can work with people to put together, you know, a wrap or a lease option or something, and just structure it. We might even could use a land trust to preserve the existing financing, and or just to make sure that there's no judgments or liens that attach to the property, because on a lease option, obviously, it would still be stuck in the seller's name. Okay, so this is, so we did kind of 2 owner financing deals here, and we saw that they also work into note deals frequently, or they can, right? Okay, now I'm just going to talk only about a note, and I would consider this as it's an upside down note deal, but it's performing. So I just got brought this about a week or 10 days ago by someone. Here's the note. And maybe you can be thinking in your mind, what would you do? The property value now is $100,000. The balance on the note is $130,000. So what do I know right now? Okay, this is it's a loan mod or foreclosure waiting to happen, because at any time this person could say, heck, why should I keep paying when I'm so upside down on the property? Okay, but he's had a perfect payment history for 5 years. His current monthly payment is $1,200 a month. The note seller is asking $68,000. So let's figure out if I would like that. Okay, what do we have? So now I'm going to clear all. And you can see, let's see, the guy wants $68,000. So let's put in that present value right there. This is also loan amount if you're figuring out a loan. And we know the payment is real close to $1,200, so $1,200. Remember, payment and future value are always entered as negative numbers, so let's make it a negative and enter it into payment. And I don't really need to know what I'm solving for. Is if I paid $68,000 for this, what would my yield be? I know that he's got on this is a 30-year note. He's paid for 5 years, so I know I have 360 minus 60. Okay, I've got 300 months left on this note. So let me solve for yield. If I bought this note for $68,000, what would I be making? Wow, okay. That sounds pretty good, right? 21% yield. That could sound like, you know, a reasonable conversation. And some of you might think that that's great. And I know that there's a lot of people out there buying for these kind of numbers. But for me, especially with a probable loan mod or foreclosure happening at some point, my max ITV or investment to value, all I'm going to do is first go, what's the property worth? 100,000. Okay, what's 50% of that? Okay, the most I will risk is $50,000. Okay, half the current value of the property. So if I bought it for 50, which we're $18,000 off, I'm pretty sure he's not going to say yes. And I know there's other people who probably would pay $68,000. If I bought it, then I'd be making a 29% yield practically, right? But then I've got a lot of risk. And so part of the reason is that sounds like, oh, why do you need such a high yield? But like I said, it's a loan mod for closure waiting to happen. And, basically, I want room to do the right thing by the payer. So if this guy can handle a reasonable loan modification, that's what I want to be able to do, right? I don't want him to lose his property. And I want my life to be simple, and I just want to make my yield and everybody wins. So what I'm figuring already, I'm buying part besides my safety factors and wanting to stay at 50% of the value of the property. I'm also going to want my yield even if I end up doing a loan mod for this guy. So if he comes to me like the day after I buy this note, and he says, "Look, I need some help here," or he misses a payment or something, then we're working into remedies for default. So what I'd want to be able to do is give him a principal reduction, as long as he can still afford it, right? Give him a principal reduction. I would write his loan down from $130,000 to $100,000. So let's work in this loan mod. And I want to make sure that even doing a really nice loan mod for this guy, I'm still going to come out really, really good. Okay? And especially if everything goes haywire, I still want to know I'm fine. So I'm going to create a loan modification for $100,000. Give him a fair interest rate here. This is good private money rate right there, 8%. And I'm going to amortize it over a shorter time so that he can actually see that he's going to own his property free and clear. This also helps me with yield, right? The more money sooner is better. So I'd much rather have a 15-year amortization than a 20 or a 30. So let's see what his payment would be. We'll solve for payment. So that's good. It not only gives him a nice principal reduction, it also shortens his amortization. It also gives him a monthly break. What is that? Almost $250 a month less. Okay, and he can probably say, yeah, that works for me. Thank you very much. He's happy. I'm happy because here's my new note, but what do I have into it? $50,000. Put that here. So let me go back and solve for my yield. Gosh, I make 22. So this is what I want to know, is that I'm going to do as good or better if I have to do a loan mod, and I'm going to be okay if, in the worst case scenario, what if the property drops 20%? What if there's a long foreclosure or lots of legal fees? And what if the collateral is trashed and I have $25,000 to dump into it before I can turn it around again? Okay, so that's kind of my thinking on that. I see no hands up at the moment. Okay, oh good. Okay, so here we are. It's a little after 6, and I try to keep these short so we can get a lot done. I'm going to unmute everybody, and you can just, if there's any questions or any deal that you have, going on right now, let's talk about it. Anyone want some feedback from myself or someone else on the call? I mean, it's great. I'm starting to get more and more emails and communications from members of the club where we're actually working on deals together. I'm helping them submit offers. Some of them include note purchases, some don't. So it's really been fun. So anything from you guys before we get off the call? Okay. Someone said, oops. Oh, why? Oh, where can you buy the calculator? Okay, great question. Okay, let's go to in a day development. Like, you can see that I've done all these owner financing and note deals only knowing, look guys, I only know 5 buttons, seriously, right? Plus the amortization. I don't actually know what the rest of this does. So I just want you to be impressed with how easy it is to, to crunch these things around. So in a day development. Okay, you can see iPhone and Android apps. So this is what it should look like if you get there. I actually have the iPhone app as well as this nice desktop app so I can do the illustrations for people. So Well, it looks like, oh, they just spoke in Long Beach. So anyway, here's where you could just iPhone. Great. So this is what that looks like if you're buying it on your iPhone. I don't know if that's visible. This little red icon is them. Okay. So great question. Thanks a lot, Sam. Anybody else? Okay. Well, anyway, thanks so much for your time. Please, during the week, submit questions or deals that you want maybe to be covered in one of these transaction review. And I think I'm going to do a little of this at the beginning of each monthly club call also, so we have kind of double the time. Plus, I'm probably going to do a few Q&As that will just be general for everyone. So anyway, thanks again. Have a great night, and hope to see you next week on the club call. Take care. All right. Thanks. Bye-bye.
Thanks. Great class.
Thank you. Bye-bye.